Good afternoon, everybody, and welcome to this afternoon's Stanball Nest webinar, Win-Win, the Power of Opportunity Zones. Today's webinar will be presented by Tim Klimchak and Ryan Luckenball. And just some housekeeping items before we jump in this afternoon. There is a handout available, which will be the PowerPoint presentation that they will be walking through this afternoon. It is in the handout section of the GoToWebinar pane this afternoon. We are offering CPE credits this afternoon as well. We just ask that you complete the 3 polling questions that are going to be asked throughout the entire presentation, as well as fill out the survey this afternoon indicating that you do need a CPE credit. On that survey, you can also indicate questions that were not answered during the PowerPoint, and you can also give us your feedback. We ask that any questions be inserted into the questions pane of the GoToWebinar panel and not the chat box, as we do not monitor the chat box at this time. And without further ado, I will pass it off to Tim and Ryan.
Thank you, Kaylee, and thanks to everyone for attending today. Ryan and I did a presentation back in mid-January that covered this topic along with some other real estate tax incentives, and based on the feedback that we got, there definitely seemed to be a lot more interest in talking about this topic because it definitely is a new and exciting area and quite a complicated area as well. So starting off with our agenda today, we're going to cover a bunch of different topics in the hour that we're going to be with you here today. We're going to start with exactly what are the qualified opportunity zones, what are qualified opportunity funds, what are the incentives of investing in a zone, how does the process work when investing in a zone, and items to consider before you would enter into this or advise other folks to get involved in it. We are only going to be focusing on the federal program today. There are some states that have some similar programs, and I think it's important to mention right out of the gate that even though this concept has been around now for a little while, there still is some things to be determined. There's been 2 batches of proposed regs already, one that came out in October of 2018 and another one in April 2019. A lot of these proposed regs have definitely been taxpayer friendly, but there's still some different interpretations of the initial guidance that came out. So, it's not unusual that there's proposed regs and then final regs, but, we're going through multiple iterations here. So as we get started here, we're going to start with our first polling question for you. And the question very simply is, how familiar are you with the opportunity zones and the related investment strategies? Are you in a position that you're not aware of the zones and what are they? You've heard of them and you have an initial understanding, or do you feel like you're an expert in that topic? So I'll give you a couple seconds here to answer that question. And as Kaylee mentioned, it is important for the folks that require CPE to answer the polling questions.
All right, Tim, I'm going to go ahead and close that down and share the responses with the crowd.
All right. Is everybody an expert?
25%. Well, most of them. Just kidding. 0% are experts. 75 have heard of it and have an initial understanding, and 25% of our crowd today are asking what even are qualified opportunity zones.
All right, sounds good. Well, thank you, Kaylee. All right, so the first step is what are qualified opportunity zones? So this was a new concept that was introduced by the Tax Cuts and Jobs Act of 2017, specifically Code Section 1400Z1 and 2. The zones are ultimately the areas of land known as census tracts which contain economically distressed communities. Now, it is important to note that each state got to indicate which areas that they wanted to count for the zones, but it could not exceed more than 25% of the designated low-income communities that were targeted for economic redevelopment. There is one special exception for Puerto Rico, allowed all low-income communities to be nominated. So if you look at the map, which we're going to show you a couple examples, we actually took a look at this and pulling this together, and almost the entire island of Puerto Rico is a qualified area. So overall, there's 8,700 tracts of land that are approved as qualified opportunity zones. They're located in all 50 states, along with Washington, D.C., and 5 of the United States territories. The designations are effective until 12/31/2028, and there is some clarification still needed as to how these designations will be continued and what happens to these investments once the zones that are not redesignated. So one of the things we wanted to start with was showing you a couple of examples of the map, and we looked at the attendees that are participating and looked at it just so you can kind of see what this looks like. So the next slide, this shows where we're located in York, Pennsylvania, as one example. If you look in the center of your map there, that's what I would refer to as the main retail district of York City. So those blue areas represent the areas that would qualify to be part of this opportunity with these zones. Additionally, we're going to show you the website here. So if you look at this website up here, it's a lot to put there, and this again will be included in the slides that we'll provide to you if you want to look for the CDFI fund. It's actually a really neat interactive website. So we have several attendees in the Syracuse area, and that's an example of what Syracuse, New York looks like, of the zones that would qualify for property that's in those areas. Additionally, we have several attendees in the Houston, Texas area today. So this kind of gives you an idea of the areas. So my take when I look at this and as we've explored the map is there's definitely plenty of opportunity depending on where potential investors would want to invest. As Ryan scrolls out here, hopefully y'all can see that, the areas that are available. So it's very important, I think, to pay attention to the zones that are out there. Moving back to our presentation, I'm going to turn things over to Ryan now to specifically, my part was really to focus on what a zone is. The next step in the understanding here is really to understand what is a qualified opportunity fund.
Okay, thanks, Tim. So as Tim alluded to previously, a lot of these regulations are based on our interpretation, as well as the most recent proposed regulations, which just came out last month. So please keep that in mind as we're discussing this topic. So moving right in there, what are qualified opportunity funds? Well, in order to take advantage of the qualified opportunity zone investment benefits, you must be invested in a qualified opportunity fund. Now, there are several flexibilities that are available for a qualified opportunity fund. It can be formed as a corporation or a partnership. The regs right now are somewhat silent on whether or not S corporations qualify. Our interpretation is that they will qualify, but once again, the regs have been somewhat silent on that. The main purpose of these funds must be that they are formed in order to invest in a qualified opportunity zone. That's a necessary requirement for these funds. So it can't be set out to invest in other opportunities. It must be set out to invest in qualified opportunity zones. One thing is that existing entities can elect to be a qualified opportunity fund. So if you have an existing LLC, you have an existing partnership, that can be a qualified opportunity fund. However, we don't recommend going down that road for some various reasons that we'll get into. Alluded to at the end of this slide here is there's a 90% test that must be met. And what that 90% test is basically out of all of the assets that are held by a qualified opportunity fund, 90% of that must be invested in a qualified opportunity zone. So as you can see, if you had an existing entity that was holding other property, other assets, that would not necessarily qualify as a qualified opportunity zone investment, which would make that test rather tricky. Another item to mention is LLCs do qualify. However, LLCs that are set up as a single member LLC will not qualify. So the way that a qualified opportunity fund goes about being in existence is through a self-certification process. This is an annual process that occurs, and it's reported on a 6-month window. So it's Form 8996. So I'm going to go through this form just from a very high level, just to kind of walk you through how this annual filing would be determined. So walking through the top to bottom there, whether or not you're set up as corporation or partnership, but highlighting question number 2 is what I mentioned earlier, is the taxpayer organized for the purpose of investing in a qualified opportunity zone property? If the answer is no, they just tell you to stop, because like I said, that's one of the crucial pieces in order to take advantage of these qualified opportunity zone incentives. One thing that's to be mentioned is that if for some reason the Qualified Opportunity Fund fails this 90% test, which is calculated in Part 2 and Part 3, the Qualified Opportunity Fund does not lose its status. However, there are penalties that are incurred, which is calculated then on the second page of the form. So if for some reason there's an issue that occurs and you don't meet that 90%, the status of the Qualified Opportunity Fund isn't lost necessarily, but penalties will be incurred. Going back to page 1 then, as far as how you would calculate that 90%, 90% itself is based on all of the assets that are in the zone versus what your total assets are being held by the fund. Now, one of the items that was clarified in the most recent regs was that newly contributed capital within the 6-month testing period is actually excluded from the calculation. So as Tim mentioned, that's a taxpayer-friendly item because you think about logistically, when new funds enter a qualified opportunity fund, if they're not deployed within 6 months, it's not going to deter you from meeting the requirements of that 90% test. Another thing to mention too is that when you go through the calculation, there's 2 different bases that you can use to determine the total asset value. One is based on a cost basis, the other is based on US GAAP basis. The only way you'd be able to use US GAAP basis is if you have applicable financial statements, which basically means if you had audited financial statements. To determine with the Form 8996, it's very much in its infancy stages. There's a lot of things that are going to be worked out with it. One thing that I just read the other day is that they're going to try to implement a little bit more information on these returns. They're really interested to see how much economic development is generated, and then they really want to track that output on these forms. So you can see that this form's going to evolve over time. So as I mentioned, the 90% test is crucial, so keep that in the back of your head. And what can make up that 90%? There's 3 main categories. You have qualified opportunity zone stock, QOZ partnership interest, QOZ business property. So those are your 3 items. For purposes of this presentation, we're going to classify QOZ stock and QOZ partnership interest as a QOZ business. The only difference is the structure of those. In order to meet the 90% test, in general, these items have to be purchased after 12/31/17. You'll notice there's a little difference with a property, it just needs to be substantially improved, which we'll get into a little bit more detail. But keep in mind that in order for the asset itself purchased by the Qualified Opportunity Fund to qualify, it has to be purchased after 12/31/2017. Back to a point I made previously, one thing about using an existing entity that deters most people in our recommendations is that any asset, even if it is in a qualified opportunity zone, if it was purchased before 12/31/17, it does not qualify towards the 90% test. So moving into some of the meat as far as the requirements and regulations that a QOZ business must follow, keeping in mind that the QOZ business could either be stock in a corporation or a partnership interest. Similar to the QOF, the QOZ business must be organized in order to invest in a QOZ property. QOZ property meaning business activities or real estate. What we recommend with that is if setting up the QOZ business through a partnership agreement or operating agreement, specifically use the terminology that this QOZ business is set up to invest and operate in a QOZ. Going into these rules now, there's several different rules that you must follow. We're still waiting for further guidance as to how annually or whatever the time period is, these QOZ businesses are actually going to qualify, that they have 70% of tangible business property, 50%, and so on and so forth. If that's going to be an annual filing, if that's just going to be a good faith that they're operating unless somebody comes and asks about it type thing. So we're still waiting on guidance from that. Going into these rules in a little bit more detail, the 70% test itself of tangible business property, again, property has to be acquired after 12/31/17. One of the clarifications that came through was that leases do qualify if they are entered into after 12/31/17. There's different ways that you can value that lease. Again, kind of resorting back to the other two methods that I mentioned before. One is if you do have an applicable financial statements or an audited financial statements, and the leases are recorded as capital leases, so there's actually a value on the books. That's the value that you can use towards the 70%. If they aren't considered capital leases, and as we know from a financial statement side of thing, that standard changes in 2020, you can go through a present value calculation to determine what that value is towards the 70% test. Additionally, with leases, there are allowances for related party leases. However, there's different stipulations that must be met in order for a related party lease to qualify. For example, it has to be a market rate lease. There's no prepayments that are exceeding 12 months. And if there's an ownership transition rule, it has to be at fair market value, so no bargain purchase options. This is strictly to ensure that this is at an arm's length transaction when it comes to the leasings. So that's where that stipulation is stemmed from. Another thing with tangible business property is that inventory in transit counts towards this requirement. So if your QOZ business is in that type of business, if you have inventory in transit, that will count towards the 70% test. Moving down next to the next rule, the 50% of gross income earned must be active conduct in the QOZ. Keep in mind that the active conduct is the key terminology there. One thing that got clarified for us in the most recent regs is if you own and operate a real estate lease, that does actually qualify as active conduct in the QOZ. Now, caution with that is currently, as our interpretation is, in general, triple net leases will not qualify. However, there is a chance that with further clarification, if there's active conduct of triple net leases, and that's what we're waiting for, that may qualify. So at this point in time, I'd caution against entering into a triple net lease in a QOZ business. Another item within this 50% of gross income earned for the active conduct that was clarified is any work that's along the lines of service type work. So there's 3 separate safe harbors that were provided to the taxpayers. And I'll kind of walk through these from a high level here. The first is you take 50% of the hours that are worked by your employees are in the qualified opportunity zone, you would count towards that 50% of gross income test, which is beneficial for many service providers as you think about it. A service performed in a location potentially is benefiting somebody outside of the zone. But if that QOZ is where 50% of those hours are being worked, that would qualify. So that's the first safe harbor. The second safe harbor is measured by revenue. So, for example, if you can trace at least 50% of the revenue that was sourced in the QOZ, that would qualify for the active conduct as well. The third safe harbor, which I won't get into too much detail, but if there's tangible property within the QOZ that's necessary to generate 50% of the income, that would also satisfy this requirement. So let's think of an example with that. Let's think of a construction company that would be located in one of these QOZs. Most likely, the activity that construction company is going to be performing is outside of the QOZ. However, let's say at the end of the day, everything comes back into the QOZ. The main operations, the administrative function is being headquartered out of the QOZ. That would still qualify for this test. One clarification that they did make in the most recent regs was that they used the example of a PO box. So let's just think of a simple contractor that is out and about, traveling contractor. If they just have a PO box in the QOZ, that does not qualify. Kind of going through some of these other stipulations that are necessary to be met. 40%, if you have intangible property, 40% of that intangible property must be used in the QOZ. Less than 5% of assets of the total assets are allowed to be held in non-qualified financial property. Non-qualified financial property would be debt, stock, partnership interest in a non-qualified opportunity zone business. And there's further clarification with that we were provided. There's a working capital requirement. So, funds come in, it might not be immediately deployed because it's cash that's in is viewed as non-qualified. However, there's a working capital clarification that was provided that if there's a written plan within 31 months that working capital is going to be utilized, and within that 31 or 30-month period, that working capital is utilized in the manner that it was written, that would actually qualify as QOZ property instead of this the 5% non-financial. And then the last point that I make here is that there's no sin businesses allowed. There's a laundry list of these sin businesses, but from a high level, you have your golf courses, massage parlors, suntan facilities, facilities used for gambling, the sale of alcohol that's not consumed on premises. So there's all these different listings as far as what type of businesses will not qualify for the zone. So going back a little bit, there's two overarching investments that a QOF can make. First one, I just went over the QOZ business. Second item here is the QOZ business property. Again, similar to the QOZ business, it has to be acquired after 12/31/17 or substantially improved. This is tangible property that's used in the trade or business. So as I mentioned previously, this does qualify as property that's going to be leased. There are original use requirements though. So the original use starts on the date when the property is first placed in service within the qualified opportunity zone. And that's the clarification that we received with that is this date is basically when the QOZ property, when this property that is purchased begins to be depreciated. So that was some clarification that was received. If property, another item was if property was vacant for 5 years before being purchased by the QOZ, the original use requirement is satisfied if it was vacant for 5 years. Then it's viewed as if it's a new property at that point in time. The substantial improvement definition is you basically have 30 months to improve the property beyond its value. So let's go through a really quick example. Let's say you have $1 million in the fund that's going towards the property, and of that $1 million, $300,000 of it is allocated to land. To meet the substantial improvement test, let's go back to the $700,000 that's remaining that's allocated to the actual property. You would then, in order to substantially improve that property, need to spend over $700,000. Fortunately, the land basis does not count towards the substantial improvement test. So keep that in mind when you're allocating, let's say, based on an assessed value or whatever that's going on. Another clarification that we received was that property that straddles a QOZ. I think this might be in some odd cases, but let's say that the QOZ line runs right down the middle of the property. You'd then be able to use a square footage model in order to test what is qualified opportunities in business property, and this is strictly in the case of real estate. So there's two main options when structuring the QOF investment. The first option is for the QOF to invest directly into a QOZ business, and this is through either the stock or the partnership interest. The second option is for the QOF to invest directly into a QOZ business property. So let's just focus on real estate here. So knowing the different regulations and stipulations that I kind of just walked through, in most cases, the QOF that invests directly into QOZ business and then into business property, that makes a heck of a lot more sense. And I'm going to walk through an example here that compares and contrasts both models here. So the first structure, which is going to be our, I would say in most cases, our recommended solution, is to first just lay out some facts here. You have a capital gain that's realized in 2019 of $1 million. That's rolled into a QOF. So we have $1 million in this QOF. What's the first rule is that $1 million, so you need 90% of that $1 million to be invested in a QOZ business or a QOZ property. So what that means is 900,000 of that needs invested in the QOZ business. This then satisfies the 90% test. Beyond that, then the next thing in the QOZ business structure is that 70% of those funds that are in the QOZ business need to be invested in tangible property. So what that means is 630,000 in this simple example needs invested in QOZ business property. What that then allows for is $270,000 within that QOZ business to be utilized for other items, as long as you're meeting those other requirements that I walked through. From a high level at the QOF, there was still 100,000 that was remaining within the QOF. So what you're left, let's think of a very simple example. You're left with $370,000 worth of flexibility is what I'll call it. Comparing the other structure, so this would be if the Qualified Opportunity Fund invested directly into the Qualified Opportunity Zone property. This is what's considered as the one-tiered structure. For that, in order to meet the 90% test, 900,000 of that needs invested in the QOZ business property. And that's kind of where it stops. So right there, then, all that's left is $100,000 of said flexibility. I think this kind of comes back there when we just compare both scenarios, left model versus the model that's shown on the right, or the two-tiered model versus the one-tiered model. Substantially more flexibility in the two-tiered model. So with that, we're going to get into our second polling question. So, how do you foresee Qualified Opportunity Fund investments being structured most frequently? So first option is a direct investment in the real estate. And the second option, invested in the Qualified Opportunity Zone. Then the Qualified Opportunity Zone business purchases the real estate. So what that should say is invest in Qualified Opportunity Zone business, and the business purchases the real estate. Third option is invest in the Qualified Opportunity Zone business, then the QOZ business leases the real estate. So just from a high level, what do you think is going to be the most frequent structure?
Alrighty, I'm going to go ahead and shut this down and show the results. All right, it looks like 28% said it's going to be a direct investment. 58% said in the QOZ business purchased in real estate, and 15% said leasing real estate.
Okay, thanks, Kaylee. Yeah, so from what the results show there, a popular decision is going to be for this two-tiered structure. And that's something that, your advisor, us, whoever can help you work through with that. So getting into, I guess, the important section of this is what are the incentives of investing in a QOZ? So now you know what QOZs are, what Qualified Opportunity Funds are, how they operate. So let's talk about the incentives. So from the initial creation and why these regulations and this code section came about was the economic development of these distressed communities. And that's the main incentive for why this policy was pushed through. And as you can probably notice, at least, it was pushed through rather quickly. It was an important topic. So that's why these proposed regulations keep coming out. But anyways, the main focus was on economic development and the creation of jobs within these Qualified Opportunity Zones and the communities that surrounded them. There was several studies that were performed that basically resembled, there was a lot of private capital gain money that was what they classified as sitting on the sidelines. So they were trying to pair these distressed communities that needed some attention with the private capital, the private funds that were basically just sitting there, giving these people an incentive to recognize or to exercise some of these capital gains. Moving forward there, within these, because of the motivation for economic development, they created a lot of flexibility within these qualified opportunities and investments. For example, somebody that lives here in PA or in New York can invest in any qualified opportunity zone across the country. There's no need to either live in that QOZ or even the state of the QOZ. So this is a federal program. Those funds can be deployed wherever you see fit, which Tim will get into a little bit later about some of the items to consider with that. So beyond the economic development incentive, let's think of the taxpayer now. There's two main incentives to the taxpayer beyond that economic development. The first is the deferral of tax on the capital gain. So let's say you recognize the capital gain. If you take advantage of one of these QOZ investments, you're able to defer paying tax on that capital gain. It essentially boils down to any taxpayer is eligible to defer an unlimited amount of capital gain. Many times this is referred to as the rollover gain. So the individual, the taxpayer, recognizes the capital gain, they roll it over into the Qualified Opportunity Fund. This must be accomplished within a 180-day period. So, and there's different timings depending on if it's through an individual, if it's a pass-through. The timing of that 180 days has been clarified. So let's think through from an individual standpoint, that day that the capital gain is recognized, you'd have 180 days from that point in time to take advantage of one of these investments. Pass-through, there's different timing because you may not fully be aware of that capital gain until the end of the year when you get your K-1. Tim's going to go into that in a little bit more detail here in a little bit. Basically, it's capital gains are the only things that qualify for this type of investment, so no ordinary gains qualify. In the year of recognizing the capital gain, there's an election that you'd make on your Form 8949, which is the schedule that details out your short-term, long-term capital gains. There's going to be an election on that year that basically signifies that you're not going to be paying any tax on that capital gain in that year. We did receive clarification that 1231 gains do qualify. However, the key word there is net 1231 gains. What that means, and this is similar to other standards and regulations within the tax code currently, that 1231 gains that come in need to be offset by 1231 losses. They kind of all get grouped into their own individual bucket. So only net 1231 gains would qualify. Another key point to mention is that when this capital gain occurs and it's deferred because of this investment, the characteristics of that capital gain remain. So a short-term capital gain will remain a short-term capital gain over the life of the investment. Same with the long-term would stay a long-term. So the deferral of the capital gain tax is the first main incentive for the taxpayer. The second incentive is a step up in basis, and this occurs based on the holding period. So if this capital gain is properly rolled within the 180-day to a qualified opportunity fund, and it's held for a certain period of time, there's step up in basis that occurs. And here's the detail of those. So if you hold the investment in the fund for 5 years, there's a 10% step up in basis or reduction of capital gains tax. This will kind of get hit home in my next example that I'll walk through with you. If it's held for 2 more years or 7 years in total, it's a 5% increase from that, or a 15% total step up in basis or reduction of capital gains. If the investment's held for 10 years, beyond December 31st, 2026, which we'll describe a little bit more in detail, there's going to be a full step up in basis, which will eliminate capital gain tax on any subsequent gains or subsequent appreciation that the fund might experience. As the regs are currently written, December 31st, 2026 is a very key date, as that's the date that the tax will be paid. So you'll have a deferral from, let's say, today until December 31st, 2026. Another thing to mention, in order to take advantage of the 7-year holding period for the 15% step up in basis, the investment would need to occur at the end of 2019 or within 2019 to take advantage of that 7-year step up in basis before 2026. We don't want to speculate on this, but there's a potential that would get extended. But as things are currently written, as things stand today, that December 31st, 2026 date is quite important. So let's walk through an example. We're going to compare two separate scenarios here, two different investments, one in a QOF versus one just in a standard investment. So let's lay out some facts here. There's a capital gain that's recognized on 12/31/2019 of $1 million. Your two options for our simplistic scenario here is that you either pay tax on the capital gain and then you subsequently invest in a standard investment for 10 years. Your other option is what this whole presentation is about, is that you take that $1 million, you'd roll it over into a qualified opportunity fund, and you'd hold that investment for 10 years. There are several assumptions that I used in this simple model. I wanted to hold as many things constant as possible. I used a long-term federal capital gains tax rate of 23.8. That's the 20% highest rate as things currently stand, plus the additional net investment income tax of 3.8. I didn't consider anything with state taxation at this point in time. For both scenarios, I used a 5% return as well. Like I said, trying to keep it as many things constant as possible. So let's go through these two separate scenarios. First one here is, you pay the tax on the capital gain the time that it's recognized, and then you hold it in just this standard investment that's returning 5% annually for 10 years. So walking from the top to the bottom here, laying out the timeline, December 31st, 2019, based on that $1 million, you have a cash outlay of $238,000. Over the life of that investment, 2020 to 2029, holding it for 10 years at a 5% compounding appreciation rate, you earn about $629,000 over the life of that investment. At the end of the 10-year period, you're going to sell out of there. So you have your investment value, which is basically the original basis plus the appreciation, less the original basis of $1 million. You have a gain of about $629,000. At that same capital gains rate, 23.8%, in 2029, you have another cash outlay of about $150,000. Switching over to scenario 2, taking advantage of one of these qualified opportunity zone investments, 12/31/2019, the $1 million is rolled into the QOF. At that point in time, there's no tax due. And this is what that first incentive really hones in on, that deferral of paying the tax on the capital gain. So this is kind of supporting the whole cash is king mentality. But for the first 5 years, the appreciation on that $1 million is the same as if we'd look at the other investment strategy. For 5 years, $276,000. To signify the step up in basis, after 5 years there, you basically had tax avoided of about $24,000 in that next section there. For the next 2 years then, there's additional appreciation at that 5% compounding factor of about $131,000. Moving forward in our timeline then, 12/31/2026, that's when we would have held the investment for 7 years. There's an additional $11,900 of tax that's what I'm calling avoided at that point in time. 12/31/2026, keeping in mind that is one of the key dates that we need to consider. The tax is due on that original capital gain amount. However, that capital gain amount was reduced by the step up in basis. So based on that 23.8% rate, only $202,000 of cash outlay occurs at that point in time. Fast forwarding then, you have 3 years that you're holding that fund at that 5% compounding factor another $222,000 of appreciation. At 12/31/2029, this is the kicker here, you held it for 10 years, that investment value has a full step up in basis, and therefore there's no gain on that point in time. So let's compare the two scenarios here. Moving through, your red items there are your cash outlays. In option one, from day one, let's say 12/31/2019, day one, you have a $238,000 cash outlay. The same appreciation in both models. As we move through, you have the step up in basis that occurs in the qualified opportunity zone investment. 12/31/2026 in the original investment, if we use option one, there's no cash outlay. However, that's the triggering event for these qualified opportunity zone investments for the capital gain to stop being deferred. So there's a cash outlay there. However, at 12/31/2029, there is no cash outlay if you're using the QOF investment strategy. There would be if you use the traditional investment strategy. So what I did here then was I said, okay, let's speak in today's dollars. So I applied a present value factor. I used that same 5% and compared option one versus option two. Option one being the standard investment, option two being the investment in the QOF. So in today's terms, what's that present value of that cash outlay? It saves you about $186,000 in this very simple model by taking advantage of the QOF investment. The key thing that gets us to this advantageous approach is the holding period. So you could go through these different models of what would happen if you went into the QOF for say a year. Well, you'd still have that initial year's deferral of paying tax on the capital gain, but the impact wouldn't be as significant as what we're seeing in this model. So keep in mind when going through these strategies. So with that being said, I'll turn it back over to Tim.
All right, thank you, Ryan. So definitely a lot to process there. For those folks that have read some materials that are out there, there definitely is a lot of people that are trying to make this a lot more simple than it actually is, and I think that's part of a sales strategy out there. So what we really wanted to try to accentuate here was, again, the fact that a lot of this is still proposed regs, and there's a lot of other things that need to be considered with this, which I'm going to talk about here in a moment. So a couple of rules that need to be followed or considered here. First of all, the rollover of the fund needs to occur within 180 days. There is no tracing for this, or there is no intermediary that's involved, similar to a 1031 exchange, which I'm going to speak to in a moment. There are timing differences for gains and pass-throughs. So, for instance, a partnership, there's a 180-day period that starts on 12/31. So if a capital gain does come through a K1 to an individual investor and they have that capital gain, they have effectively that 180 days or sometime for a calendar year cash basis individual taxpayer is going to have till the end of June until they have to make that, roll this in there. However, if the partner does know about the capital gain as the date that it actually occurs in their underlying partnership, they can use that earlier date instead of the later date when they actually get the K1 as of, say, 12/31. The 12/31/2026 is the last day for a new investment. Again, unless it's extended, how we're presenting things today are really focusing on what tax law is there now. I think if this program is successful, I think you'll see some opportunities that some of these things do get extended. The tax paid at 2020, the tax is paid on, as Ryan said, in 2026, or when the investment in the fund is sold, whichever is earlier. Another key point that you might be thinking about is, okay, we're talking about appreciation and continued growth here, but what happens if things don't work out the way that you anticipated? Well, if the qualified opportunity fund does lose value, then the tax is due on the fair market value of the investment when it's sold versus what the original capital gain amount is. Then for the 12/31/2047, which right now seems like it's very far away, but I guess it'll be here before we know it. That is currently the last date for fund availability, again, unless it's extended. So the sale of the fund would need to occur beforehand as currently written. Moving on to some basis considerations. Ultimately, we've discussed the fact that we're putting capital gain dollars in here. There is no reason that it has to be limited to capital gain dollars. The benefits of the deferral of the capital gain is really where that's driven by, but it can be also other money that's on the sidelines, after tax money. So if separate funds are invested in the fund, they are treated separately and have a separate basis. It's considered a mixed fund investment. So the money that's being put in as a capital gain is coming in with a zero basis, whereas any other money that isn't part of this capital gain deferral, you would get credit for the basis inside of the corporation or the partnership based on the dollars that you are putting in. Amounts contributed that do not relate to those capital gains are also not eligible for a step-up in basis. So again, from a tracking perspective, if you have multiple capital gains invested in the fund and then they are subsequently disposed of, you must use the FIFO method with regards to this. So I think that's another key point here in terms of doing a weighted average model or a LIFO. You need to treat the capital gain money coming in as you get out of the fund. If there are multiple investments over a period of time of that capital gain, it's got to be done on a FIFO level. It kind of goes without saying, we have not commented on this, but you are going to have a partnership or a corporate ownership here that ultimately there's going to be operating results and taxable income or loss from the underlying activities. So you are going to get a K1 in the instance of an S corporation or partnership. You are going to get a K1 from the activity, and it's going to look very similar to any other investments that you might have. So there's definitely risk of economic loss or gain as part of your investment, and there will be current tax on that. Another thought process under the partnership rules is, and this came through on the most recent regulations, is the fact that there can be outside basis for inside debt, meaning if you personally guarantee debt inside the partnership, that can count as basis as part of your partnership interest here. Related party stipulations, we had some folks that we know actually comment to us and ask this question. And I think it's an important point, and Ryan did touch on it earlier, that what do I do, Tim? I own a property that's currently in one of these zones. What can I do about it? Well, number one, it hopefully, because of this incentive, it's going to look a lot more valuable as an asset for you. Hopefully it results in a larger capital gain for you. But can I just take those investments and just roll it into one of these funds? And that's not really what the spirit of this is. The goal is to really promote the economic development. So the owners of existing properties are precluded from selling their current investments to a fund and then just reinvesting the capital gain into the same fund. However, they can do it if ultimately at the end of the day they own less than 20%. They own 20% or more of the fund is when they're precluded from doing it. So if they own less than 20% of the investment, meaning they contribute property, but other investors come to the table that they bring or someone else brings to the table, there is a way that you can contribute property here. But that person that contributes that property, they have to own less than 20% of the underlying fund. So moving on to some items to consider before investing in the quality opportunity zones. The biggest thing that this might smell like for anyone that's familiar with real estate investment is a 1031 exchange. So we wanted to kind of do some comparing and contrasting for those that are familiar with 1031 exchanges. So there definitely is some things that are positive and negative on this issue. First of all, the total investment, I think this is the biggest one. In a 1031 exchange, you're required to take the proceeds and roll it into another like-kind investment, meaning another real estate investment. In this zone fund opportunity, in order to get the benefit, you can only put in the capital gain if you so choose to. So for instance, if you had a $10 million building and had a $2 million basis and an $8 million gain, in the zone model, you'd only have to put in, you could put up to the $8 million gain. It could be something less than that, where on the 1031 side, you'd need to put in all the proceeds. The 1031 also requires an intermediary, is required to facilitate the transaction. In the fund model, there is no such clause for that. Investment type, both are for real estate, but the zone model offers that it can be invested in business, as Ryan had went through before. Treatment of losses with a 1031, pass-through losses are available. On the fund side, pass-through losses are only available, but not until a basis is established. So if you have if all you have done is invested your capital gain money into this investment, your starting basis is zero. So if you do have a loss right away out of the gate, there's a chance that there might be some limitations, with regards to those losses to be able to take in the current year. The deferral period, the 1031, you can defer it as long as you own the asset. You can roll it into another one and so forth, where, as we've covered before, the deferral in this case is really only good until 2026 for this seven-year period. The subsequent investment requirement, again, with the 1031, new property must be equal or greater fair market value than the previous property, where there is no such clause with regards to the zone. Our final polling question as we wrap up the last 10 minutes or so here is, knowing what you know now, would you invest in a qualified opportunity zone? It's kind of a trick question early on, because I'm going to talk to you briefly here about some pros and cons right after we get done the polling question of what our thoughts are on the topic. So I'll give you a couple of seconds to look at that.
All right, I'm going to go ahead and close this down and share it with the audience. We have 53% that said yes, 8% that said no, and 40% are actually still unsure.
Oh, that sets up nicely, I think, for the last 10 minutes here. So and that's kind of where we are with it, in terms of, the clients that we've talked to about it. Like I said, there's been a lot of guidance out there, and I think some of the large investment bodies out there, some of the banks, some of the private equity money are trying to really accentuate the fact that this is a great strategy, a great way to defer and maybe eliminate some tax. But the way we're looking at this is, yes, there is a lot of positives to it, but there are some things that that aren't negative, but need to be considered with regards to these investments. One thing is about the rollover within a qualified opportunity fund, the reasonable reinvestment period. The most recent proposed regulations include a reasonable period of time to reinvest. So, for example, if the fund sells its interest in the zone business, has a year to reinvest, and during this period, the proceeds are considered qualified opportunity zone property for purposes of the 90% test. Additionally, with regards to this opportunity, there definitely will be some strategic ways to use some other tax incentives with regards to credits, including historic tax credits, new market tax credits that can be worked into these deals as creative developers are looking for opportunities to attract new money to some of these economically depressed areas. Kind of as we talked about, there's a list of items that are listed as inclusion events that in the proposed regulations that you need to be aware of. And these are some of the things that are coming up, like, okay, what about if I have a capital gain and I want to gift my interest in the fund to someone else? Is that a triggering event? So that, which it is, and that's what some of these questions that are currently being asked that are out there. As I mentioned before, if it does lose value, the deferred gain is reduced to fair market value. So you need to understand what kind of investment that you're getting into. Many of the rules and interpretations, like we said, everything's a little bit of a gray area right now. So it's something that needs to be considered and definitely needs a little more time and research. It's definitely not, it can be a deterrent to want to, go full bore into this, but at the same time, there is some limited windows here that we want to make sure that we capitalize on. It is a new concept with little history or success of failures. And when it comes to these national approaches, that there's large private equity companies, if you go online and look for qualified opportunity funds, you're going to see names of capital companies that I wasn't familiar with that are focusing on saying we have 50 million already under investment, we have 500 million under investment, and it's in one specific state or maybe it's multiple states. So it looks like it creates a turnkey operation, very much similar to a mutual fund or a REIT perhaps, where I'm just investing my money into this thing. But my challenge to that would be, again, with some of the regulations with this and the fact that it's self-regulated, some of those other investments are usually subject to SEC filings and so forth. And in terms of a bunch of different factors, understanding what you're getting into. And that leads into, the decision, if you do decide to do it, of whether you want to do this on a national approach, or is this something that you want to do on a more local or regional level, maybe with investors, with other real estate investors that you're aware of, and putting some people together that maybe have already done some business together. So, for instance, looking at a partnership or an operating agreement, for those of you familiar with those type of agreements, you are entering into a partnership and you are buying units, let's say, in an LLC units or a partnership interest with other investors. There's ultimately going to be a designated manager, so we would caution to look at those partnership and operating agreements, whether you're on a larger approach or a smaller, more local approach, just to understand what responsibilities does that member have, what kind of decisions can they make on their own without reporting to a board or to the unit holders. What is their fee for the work that they're doing? Also, the biggest question for me is, let's say I want to recognize my gain and get out of the fund. How is valuation considered? Well, that operating agreement should say something to the effect of, are the assets or is the real estate appraised, and is it appraised once a year? And if I want to get out on June 30th, it's going to be based on the value that's established at 12/31 of the prior year. So there's a lot of things with that. Additionally, with in looking at whether you want to do this on your own or do it on the broker-driven side, there is going to be some tracking of individual investments, as I said, with the gains and whether you have basis or don't have basis. If you're putting multiple capital gain dollars in at different times, who's tracking that? Is it going to be your responsibility to do it? Is it your accountant's? If you're one of these larger funds, is it their responsibility really to focus on that? So another key indicator is, if you really are focused on, let's defer the tax, let's potentially avoid some tax, it might be important for you to understand where your money's going. Is it going to be more important to do this more national approach, which does create some diversity? If you have some concern about putting all your eggs in one basket in a current area, maybe your current location or an area that you're aware that needs economic redevelopment, or do you want to find an opportunity to diversify into different areas? So again, just in closing, as we wrap up here, appreciate everyone's time on this issue. We're going to be sending the slides out to everyone who was participated with us today. If you have questions, we'll be happy to answer them and help you work through it. As we said, it's definitely a complicated area. There definitely should be a lot of questions, and I think that's what we're already seeing in the marketplace already, and that's why we have all these proposed regs and we don't have final regs yet. So appreciate everyone's time today, and thank you for joining us.